Hello, I'm David Hardesty. This lecture continues our three-part study of acquisitions and dispositions of web-based businesses with an examination of the formation of e-commerce corporations. We're not going to study all aspects of the incorporation of a business, only those issues that are of particular concern to electronic commerce and the acquisition of web-based businesses. Accordingly, the objectives of this lecture are as follows. To understand the tax implications of transferring intangibles, such as software, to new corporations. Understand the implications of transferring services to new corporations. Understand the tax implications of licenses of property to new corporations. Understand how to differentiate between transfers of property versus transfers of services. Understand how to differentiate between transfers of property and licenses. And understand how to determine when there is a receipt of stock. The first topic is transfers of intangibles to new corporations in exchange for stock. As discussed in the text at 8.03, if property is transferred to a corporation in exchange for 80% or more of its stock, then the transfer can qualify as a tax-free transaction under Section 351. Gain is ordinarily recognized in a property transfer when property other than stock is received by the transferor. In addition, when the liabilities transferred in connection with the property exceed the basis of the property transferred, then gain is ordinarily recognized. Intangible assets, such as patents, copyrights, software copyrights, and know-how, all assets that are important in electronic commerce, are usually property that can be transferred tax-free under this general rule. Here's an example of a transfer under Section 351. Smith & Jones form NewWeb, a new corporation organized to provide online services. Smith & Jones will each receive 50% of the new company's stock, so the 80% ownership test is satisfied. Smith transfers cash of $1 million to NewWeb, and Jones transfers separately owned copyrighted software and patented technology valued at $1 million, with a basis of 0. The cash and property can be transferred tax-free under Section 351. In addition, the corporation assumes a $100,000 loan from an unrelated person, which is a joint liability of Smith & Jones. Jones' share of the liability is in excess of his basis and assets, so Jones will recognize boot income of $50,000. Now let's look at the treatment of transfers of services to corporations in exchange for stock. As explained in the text at 8.034, the transfer of services to a corporation in exchange for stock is taxable. Section 351, discussed earlier, applies only to property transfers, not to transfers of services. There is no code section that protects an exchange of services for stock from being taxable. The issues in a transaction involving services are usually twofold. Is this truly a transfer of services? And has stock actually been received? As we will see, it is sometimes difficult when intangibles are being transferred to determine if there is a transfer of an intangible or a transfer of services. In addition, in many cases involving electronic commerce enterprises, stock is not received outright in exchange for services. So we often have to determine if and when stock is actually received for tax purposes. Here's an example of the issues that arise as a result of a transfer of services. Smith & Jones form NewWeb, a new corporation organized to provide online services. Smith & Jones each receive 50% of the new company's stock, 1,000 shares each. Smith contributes cash of $1 million, and Jones contributes patented technology worth $750,000, and a promise to perform services for the corporation without compensation for a period of 2 years. Both Smith & Jones are transferors of property, so the 80% test is met. However, Jones has immediate compensation equal to the value of the stock he receives in exchange for the promise to render future services. Let us change the facts and assume that Smith receives 1,000 shares of stock in exchange for cash, and Jones receives 750 shares of stock in exchange for the technology, with a promise of 250 additional shares when he fulfills his 2-year promise of services. In this case, Jones does not have immediate income with respect to the receipt of shares. Instead, he recognizes compensation income when he receives the additional 250 shares, and the amount of the income recognized will be based on the value of the shares when they are received. Now, let's discuss licenses to new corporations in exchange for stock. Like services, a license of property to a corporation in exchange for stock is a taxable transaction. Once again, Section 351 does not make such a transaction tax-free because there is no transfer of property in exchange for stock. Here's an example of a license of technology to a new corporation. XYZ is a U.S. corporation that provides certain services. It forms WebCo, a U.S. corporation, to provide those services online. It licenses certain technology to WebCo, which is necessary to provide the services online. This is a 3-year, non-renewable license. This does not appear to be a transfer of the technology, only a license of it. Accordingly, the license is not property for purposes of Section 351. Earlier, I mentioned the problem of differentiating between property and services. In most cases, it will be clear whether there is a transfer of property or services, but not always. As discussed in the text at 8.034 and 8.035, Whether there is a transfer of property for services depends on the facts. The two most important facts in determining if there is a transfer of property are as follows. Did the transferor own the property prior to the transfer? And was there a completed transfer? For example, assume Smith engages Jones to create software. After the software is complete, Smith and Jones decide to form a new corporation, and Jones transfers the software to the new corporation in exchange for stock. Ordinarily, this will be a tax-free transfer, but what if the arrangement between Smith and Jones is such that Jones did not own the software? This can occur if the arrangement between Smith and Jones was a work-for-hire contract. In this case, Jones never owned the software and cannot transfer it tax-free. In essence, he receives stock as compensation for services performed, which is a taxable transaction. Let's now differentiate between a transfer of property and a license. As discussed in the text at 8.032, only a complete transfer of property is tax-free under Section 351. In the case of an intangible, a complete transfer requires a substantial transfer of certain rights. The transfer of the physical property itself is insufficient for a complete transfer. In the case of a software copyright, for example, at least one of the copyright rights must be legally and completely transferred. The transfer of an intangible for use by the corporation without a complete transfer of rights in exchange for stock is ordinarily a license of the intangible and a taxable transaction. An example is provided in the text at 8.035e, where there is a discussion of transfers of know-how. In this discussion, the point is made that if know-how is transferred, the transfer is not complete unless the transfer is accompanied by the right to keep the know-how secret. Here's an example of the transfer of know-how under an exclusive license. XYZ Inc. is a U.S. corporation that provides certain services. It forms Webco, a U.S. corporation, to provide the services online. On formation of Webco, XYZ personnel spend several months training the Webco personnel in certain unpatented but secret processes, know-how, necessary to the provision of the services online. This know-how is transferred to Webco under an exclusive perpetual license. The license prohibits XYZ from providing this know-how to any other person who would provide these services online, and which prohibits XYZ from employing this know-how in providing the services online. This appears to be a complete transfer of the online rights in the know-how to Webco, constituting property under Section 351. Stock transfers in exchange for services are often not initially complete, which raises important issues for new business and corporations. Stock issued by a new business in exchange for services is often subject to certain restrictions. If these restrictions are such that the stock is subject to a substantial risk of forfeiture, then the stock may not be considered to be received. Such stock is not considered to be received for tax purposes until the risk of forfeiture lapses. This is an important rule because it is very common for employees of e-commerce enterprises to receive such restricted stock in exchange for services. As discussed in the text at 8.034c, where such stock is received, the recipient does not recognize income until the restrictions lapse, and the amount of income recognized is based on the value of the stock at the time the restrictions lapse. However, when restricted stock is received, the recipient has the option to elect to treat the stock as not restricted, in which case the recipient recognizes immediate income based on the value of the stock when it is received. This election, which is the 83B election, is often advisable when the stock received has a low value when initially issued but is expected to grow substantially in value. Here's an example of the receipt of restricted stock. Smith & Jones formed NewWeb, a new corporation organized to provide online services. Smith & Jones each receive 50% of the new company's stock, 1,000 shares each. Smith receives 1,000 shares of stock in exchange for cash, and Jones receives 750 shares of stock in exchange for separately owned technology and 250 shares in exchange for a promise to provide services for 2 years without pay. The 750 shares received by Jones are not forfeitable. However, if Jones fails to provide the promised 2 years of service, he forfeits his rights to the 250 shares. The 250 shares received by Jones are subject to a substantial risk of forfeiture, and the value of those shares is not immediately taxable. Instead, Jones is taxed on the value of those shares at the time they vest on completion of the 2 years of service. As an alternative, however, Jones can elect to recognize compensation on receipt of those shares based on their initial value, in which case he recognizes no further compensation when the shares vest.